Imagine following Warren Buffett's style of investing for 5 years and still underperforming the Indian market. Between 2015 and 2020, the value investing in India delivered negative returns. Next few years, something extraordinary happened. From 2021 to 2026, the same strategy became one of the India's best performing investment style. Same strategy, same market, but completely different result. So what works in Indian stock market? Value, momentum, quality, or low volatility? We analyze more than 20 years of Indian market data to answer one simple question: which investment style give investor the highest probability of beating the market? And the answer even surprised us. Savvy data suggests nearly 95% of individual investors fail to outperform the market. Many of them lost their hard-earned money. Here is the shocking part. Most of the investors don't fail because they choose bad strategy. They fail because they abandon good strategy at exactly wrong time. And if you are already investing in the stock market or planning to start, this video could save you from making one of the biggest investing mistakes. Today we are going to study 4 major investment styles, analyzing 20 years of real Nifty factor data and how to beat Indian market by choosing right framework. Because investing is not just about choosing a strategy, it's about surviving long enough for that strategy to work. Before we look into the numbers, let's quickly understand the 4 factors that have historically driven stock market returns. Value investing. Value investor buy fundamentally strong company trading at a cheap valuation. Think low PE, price to earning ratio, low price to book value. The belief is simple. Market eventually recognize the true value. Warren Buffett makes this style very famous. Number 2, momentum investing. Momentum investors buy stocks they are already going up. Why? Because trend often continue longer than the investor expects. In simple word, winner keeps winning. Number 3, quality investing. Quality investor focus on business with high ROE, return on equity, high ROC, low debt, consistent earning growth. These are companies with strong balance sheets and durable competitive advantage. And the final 4th one, low volatility investing. Low volatility investors prefer suitable companies that fluctuate less. These stocks usually fall less during the market correction. They may not always lead during the bull market, but they help investors sleep peacefully. Now here is the important point. Every one of these factors has beaten the market at some point. The question is, which one worked best in India? Let's look at the data. Most performance metrics show a simple chart and declare a winner. This is exactly where investors make mistakes. Now you just go to Google and search top large cap fund or flexi cap. Every side has their winner and loser. Because point to point return are extremely misleading. You change the start date and you change the end date, and suddenly the best performing fund becomes the worst performing fund. Professional investors use something much better: rolling returns. Rolling return asks a much more realistic question. If you have invested on any random day during the last 20 years and stay invested for 2 to 5 years, how often would this strategy has beaten the market? Because nobody invests perfectly. You invest when you received your salary. Sometimes market are high, sometimes market are low, mostly somewhere in between. Rolling returns tells you what your actual investing experience would have been. Let's first look at the period between 2015 and 2020. This was the golden era of momentum and low volatility. Value investing delivered negative 6.7% annual return. That time, investor did what investors always do. They chase recent winners. Money flooded into momentum fund. Value investing was abandoned. Many guru declared value investing is dead in India. Then came 2021. PSU bank recover, manufacturing rebound, capital goods surge, neglected sectors started re-rating, and suddenly everything has changed. The strategy investor has abandoned become the biggest winner. Nifty 500 value delivered almost 28.5% CAGR growth during next 5 years. Same factor, completely different outcome. This is where the investor lose money. They abandon a strategy after years of underperformance, right before the recovery phase. With my 20 years of experience, I have seen this happen repeatedly. Investors do not suffer because of bad strategy. They suffer because of poor timing. Now let's look at the rolling return number, because this is where the real answer lies. Over long period, Nifty momentum delivered around 21.9 CAGR. The quality delivered roughly 16.8 CAGR. Low volatility delivered around 15.9 CAGR. Value delivered approximately 14.3 CAGR. And the benchmark Nifty 500 delivered roughly 13.6 CAGR. Purely from the returns perspective, momentum wins, and it wins by a wide margin. But headline returns never tell you the complete story. Momentum also comes with high volatility, larger drawdown, higher portfolio turnover, higher tax and transaction cost. Quality and low volatility generated low return, but they provide a much smoother investment journey. And investing smooth journey matters, because smooth journey keep investor invested. Here is the biggest insight from this entire study. No factor win all the time. Every factor has a season. Think about cricket. A fast bowler dominates on a green pitch. A spinner dominates on a turning tap. You don't permanently choose one. You choose according to the condition. Factors behave exactly the same way. Momentum thrives during the strong bull market. Quality outperforms during uncertainty and economic downturn. Low volatility shines during the market correction. Value performs best during recoveries and re-rating cycles. The challenge: nobody can consistently predict which phase comes next. So what should investor actually do? The data give us a clear answer: diversified across factors, because factors have low correlation. When one struggles, another often performs well. A multi-factor portfolio reduces regret, reduce risks, and dramatically improve that the probability that you remain invested for a decade. And staying invested is what ultimately creates wealth. If you want us to help you to build a right factor allocation to your portfolio, please fill out the form in the description below. My team will personally reach out to you. If this video changed the way you think about investing, make it count, share it with one investor you know. I will see you in the next one. Cheers.